Hi, welcome to valuationpodcast.com, a podcast and video series about all things related to business and valuation. My name is Melissa Gragg, and I provide online divorce mediation and valuation services in St. Louis, Missouri. Today, we will discuss insight into dental market transactions with Maria Melone. Maria is a leading M&A advisor to the dental industry and an investment banker in Chicago, Illinois, with a mission to help both individual dentists and dental groups navigate the complex landscape of dental practice transactions. Maria is the managing director at Caber Hill Advisors, also located in Chicago, Illinois. Welcome, Maria. How are you?
Great. It's so good to be here today with you, Melissa. Really looking forward to this.
Yes, I know. And it's so funny because since we kind of scheduled this, we've actually talked a lot to each other about other dental practices. But I think in general, people, when they're in this process of valuation, they're usually doing the valuation for some reason, right? And when we look at dental practices, a lot of times they're doing it to either transition the practice to new dentists or to sell it outright. And just kind of getting started, I don't know if people really know how dentists are currently selling their practices. These things change over time. So maybe you can give us kind of a reference point.
Sure. Happy to go into a little bit of history and then bring us to where we are today, as there has been quite a shift. So historically speaking, the dental industry was really very much a cottage industry, mostly made up of solo practitioners spending their entire careers in a single location, and then transitioning or selling that business to a doctor coming out of school. And in that process, most sellers relied on a broker to help facilitate that process. However, very interestingly, I guess, especially from where I sit, most of these brokers across the country, were not financial people, were not accounting people, didn't have any valuation training, but somebody showed them, anywhere from 3 to 8 methods of how to value a business, most of which were very subjectively based. And so, that was what was used, and there wasn't a lot that was questioned about it. And then, I would say starting about 20 years ago, we started to see an interest in consolidating the dental industry. And so we started to see the formation of, what I've always referred to as group practices. 20 years ago, a lot of people in the industry would say corporate dentistry. I really try to stay away from that because it has a bit of a negative connotation to it. But, as we saw that happening, that then invited more sophisticated parties to the space. And with that became a more sophisticated view and approach to how to value a business. And so, what used to be considered a valuation standard was percentage of collections. And so, oftentimes when I talk to solo practitioners, even still today, sometimes they'll ask me, what do you say the value of my business is? Is it 70% of collections? And, I try to help them understand that that's really a reference point. It's not a valuation methodology. And so, where we are today with most of the sophisticated buyers, the way that they're looking at a dental practice, whether it's a single location or, multiple locations, is a multiple of EBITDA. And so that's really becoming sort of the standard for how investors are looking at these businesses, whether they're entrepreneurial dentists that are trying to accumulate a number of locations, or the more sophisticated strategic buyers and or private equity firms backing them, or independent private equity firms trying to make an entree into the space.
And I think EBITDA, people can kind of confused at what it stands for EBITDA, earnings before interest, taxes, depreciation, and amortization. But a lot of times it's just cash flow, right? It's
Yep.
like what's going into the pocket of the doctor or dentist, and what could an outside investor kind of look at. But a lot of times when they come for a valuation, they're really looking at like, how much could I sell this for? Right. And they're
Yeah.
like, I want the biggest number. So what's the biggest number I can get? But that's not actually how we look at this, right? Because there's a way to price a dental practice to sell.
Yep.
Okay. And then there's a way to like hope that you get millions of dollars for whatever you want. Like a lot of times people are saying, I just want somebody to pay me $2 million. And it's like, okay, what's the basis for that? So is
Right.
there really a basis of how you price the practice to sell, and what kind of goes into that process on your end?
Yeah. It's really a tough question to boil down into a nice, concise answer. As with any business, there's so many facets of what truly makes that business tick. And when we think about, dental practices in particular, by far the largest majority of the value of a practice, or even, a group of practices, is in the intangible asset, the goodwill of those businesses. And so, when we look at the value, the things that we talk about are growth. So, does the practice have a history, or even multiple locations? Is there a history of historical growth? And is there any sort of path or identified path for continued growth? And that can either be, adding an associate, adding a hygienist, maybe going to a continuing education class and learning how to do implants. And so now you're increasing the types of procedures that you can perform. It can be doing an acquisition of an existing practice, or building a practice from scratch, which we refer to as de novo. So, I would say growth is typically one of the biggest things that we look at, certainly for a solo practitioner. And this happens, or at least I've come across it many, many times, where a doctor gets later on into their career, they start to either scale back their time. So maybe they go from 4 days to 3 days. Maybe they are also scaling back the types of procedures that they're doing. So, and then we see a revenue drop. And, a lot of times those doctors will come to me and say, well, but 2 years ago I was doing 2 million, and I was like, that's great, but this past year you've only done 1.4 million, and somebody can't pay you based on 2 million, because we don't know if those patients that made up that $2 million revenue stream are still part of your practice, and chances are they're not. And sort of related to that, one of the things that I, typically focus on is new patients per month. And to me, that's a very good indicator of if the practice is truly a dying practice, or if it's a healthy practice that's continuing to bring new patients in. And in fact, I like to look at that more so than what a lot of people look at and focus on, which is active patients. And I find that most people that aren't, well educated in the dental industry get hung up on this active patient count, when in fact, nobody has a definition. There's no standard definition of what an active patient is. So is an active patient someone that's come in the last 12 months, 18 months, 24 months? Does that include an emergency visit that, maybe they've only had one visit and we don't know if they're ever going to come back for continued care? So, and then also, all of the softwares tend to measure that differently. So, in my opinion, it's really, not a very good thing to focus on. And then other things that we look at obviously are the physical plant. Is the practice or group of practices modern and up to date? Are they, today digital radiography is really, I would say, considered a standard of care. And so, if your practice doesn't have digital radiography, that's definitely seen as a negative and something that, a new owner is going to have to make an investment in pretty quickly, especially because, all of the younger practitioners nowadays are trained in that. And so, along those lines, it's so interesting to me how many doctors, especially solo practitioners, they opened their practices 35 years ago. I'm sure they were beautiful and state of the art at that time, but they've really neglected, to make any investment into the practice. And, now, we're faced with a tough situation where, again, somebody's going to have to come in and certainly do at least some cosmetic stuff, but more likely some significant investment into, the chairs and the equipment and even computers and desks and things like that. And then probably another big area would be the staff. So having a trained staff, obviously, is very important, especially when you think about a doctor to doctor transition. Most doctors that are coming into practice ownership don't have experience with that. And, most younger doctors, even though, maybe they've worked a couple years in a practice, they're still working on their clinical skills. And so having a trained staff there that can support them and help them with, more of the non-clinical aspects of the practice, but also help them, work on developing themselves clinically, is really important, especially for those younger practitioners and new owners of businesses.
Well, and I think to hit on a couple things that you talked about, which I thought were interesting, is that I would assume that a lot of doctors do this, which is they, instead of saying, oh, let's go sell the practice because I have this $2 million in revenue right now, they're just like, well, I'll just work 4 days. I'll just work 3 days. I mean, because I talk to a lot of them that is exactly where they're at in that process. And I didn't really think about it from that perspective, that now you have like you're doing it for your own life balance,
Right.
but it's literally dropping the price and it's just a choice, right?
Yeah.
And it will create the attrition though of those clients because eventually, and it could just be, I don't want to do those services anymore or something like that. But the other thing that I thought was really important was the new clients. So can you combat the fact that your total practice has declined if you can show that we have a constant, new clients, that maybe we turn away clients or maybe we don't take on certain clients? Like, is that even effective for a buyer?
It's really very difficult. Probably the only way you would get credit for something like that would be in some sort of earnout or deferred payment based on, the practice growing. And, as a buyer, or counseling a buyer in that scenario, I'd probably discourage them from doing that because it becomes very difficult to determine if it's something the buyer did to now bring in, some new patient flow, or is it truly something that the seller is doing, or the effects of something that the seller has been doing coming to fruition at some point in the future. So that's really a tough one, I think.
Well, and I think it's a
for.
huge takeaway for dentists.
Yeah.
Because that is what everybody kind of does, is start to transition and just, I'm going to run this forever.
Yeah.
And I wonder if some of the buyers actually kind of know that that's what's going to happen. And that's when they can get better deals or something like that, because, you know, they're just paying on 3 days worth of services as opposed to 5 days worth of services. So in some capacity, getting maybe another doctor, a younger doctor staff, or more hygienist may be a better way to have more life balance
Yeah.
than, and people don't, you know, that thing seems more risky,
Right.
right?
Right. I mean, there's definitely headaches that come along with those things as well. But I think the other interesting aspect of this is really when it comes down to the size of the practice. So going from a $2 million practice to a $1.4 million practice, you're still going to see a lot of interest for that size of a business. But when you talk about going from a $750,000 practice to a $500,000 practice, surprisingly, it becomes very difficult to find a buyer for that $500,000 practice. And the reason is kind of twofold with what we see going in the marketplace today. One is for the typical doctor coming out of school. I haven't checked super recently, but the last figure I had was that their educational debt alone was approaching $300,000 on average. And that doesn't include specialty. Specialty, they're probably well over 500, you know, maybe even over 600,000 of debt when they come out of school. And so when you think of that, and you think about the fact that those candidates are also likely looking to do some life changes. So maybe they're getting married, maybe they're going to have a family, maybe they want to buy a house. You know, not that they can't get access to capital, but sometimes that can be quite overwhelming to be that young and sitting on probably what would be well over $1 million of debt. And you know, also related to that is definitely under $500,000 of collections. You're now getting into a situation where you're probably not going to be able to generate enough money to pay off any debt and still have a decent living. So that becomes very challenging to transition those practices to younger doctors or first-time owners. You know, for group practices, you know, they generally want to bring on and acquire successful, thriving businesses. You know, that being said, there are some groups and some entrepreneurs that will take sort of the gamble of stepping into taking over those practices with the idea that they'll grow them to something that's a lot more attractive. But I would say more than not, most of these larger buyers are really looking for those practices that are already, you know, doing very well and are very healthy.
Mm-hmm. Well, and I think, and I'm not trying to belabor it, but I think it's just an amazing, I just didn't even think about it, that most of them will, in their transition to retirement, the easy path seems to just take off a day and scale back, when the reality is that may not secure a good price when you go to sell in a few years. Whereas taking on somebody and finding another dentist, not even for them to be the potential buyer, just to keep the practice
Right.
at a level that is actually saleable, seems to that would work in his best interest. You also mentioned something which I think is very interesting to me. I kind of became familiar with this concept several years ago, whenever we had a couple practices being approached by a DSO or a group practice. And can you tell us what is a DSO or group practice and how they are actually buying dental practices right now?
Sure. So, you know, most people, I would say, would define DSO as dental support organization. And typically what that means is it's really meant to help non-dentists become partners with dentists. Now, that's not to say that a dentist can't, you know, can certainly be an owner of a DSO, but the primary reason for the formation of this structure is to provide the opportunity for those non-dentists to be able to partner And you can take that partner term, very loosely or very stringently, depending on your perspective and how you want to go about this. But, the reason for this is that in most states, only a licensed dentist can own, for sure, the clinical aspects of a practice. So patient charts, contracts with insurance companies. And then, state by state, there are rules and regulations regarding who can employ, hygienists, dental assistants, and then more of the administrative or clerical team. So that, that's the nature of where that started, again, was to bring in a more sophisticated business mind and business acumen into this industry that was now seeing consolidation. And so, what I think is also interesting is the shift to my train of thought.
And even, I mean, because this kind of piggybacks, and when we were talking about this, these kind of piggyback together, right? Like I only saw like DSOs, right? And then when I talked to you, it was like, wait, there are also private equity firms, getting involved in buying dental practices. And I think it's really interesting because in my mind, the DSO model or private equity was created so that people could come in and we have these dentists and they're really smart, but maybe they're not as efficient with the business process.
Yeah.
And so these DSOs are like, well, how do I be a owner, but not a dentist, but I could make it be efficient and we could make more money?
Yeah.
Is that kind of how, and now private equity is coming in and saying, now we want to get involved. Well, is there a difference in how they're getting involved than the traditional DSOs, or is it similar?
No, I mean, there's definitely been a big evolution to this. Although I will say that, from the very beginning, like, over 20 years ago, when I first got introduced to the industry, we didn't call it DSO back then. We actually called it DPM, Dental Practice Management Company. This is how we were described. But even back then, there was private equity money that was supporting some of these early groups. And actually, there were a couple of groups that were publicly traded. So I ended up working for one of the companies that ended up being publicly traded. But, over time, I think what has been seen, especially by the investing community, is the fact that dentistry is recession resistant. So, you think about 2008, most dentists took a little dip in their, top line and bottom line, but weren't significantly or severely impacted. We didn't see dentists closing their offices because of losing patient bases. And, there's very much a growing trend in dentistry. I mean, I think in healthcare in general, obviously, but in dentistry in particular, for a few factors. One is people are living longer, and they're living longer with their natural dentition. And then we also are getting into a point where we're going to have more, say, 50 plus, who tend to have access to more disposable income. And I think there are also a lot of technologies that are coming into dentistry that are providing people solutions for, more cosmetic-based care for these people that now have, access to be able to invest in themselves and invest in their smiles. The other thing I did want to go back to was the DSO versus group practice. The way I think about it is they're synonymous. I just tend to use the word group practice because, again, I think, in some circles, using the term DSO may, bring a negative thought into somebody's head. And so I just like to talk about group practice, and group practice can be, anything from a single location with 5 doctors to 1,000 offices.
Well, and you just kind of spoke about it, but you basically worked for a company that was purchasing a bunch, a publicly held company that was purchasing dental practices. And I think this is I know that this is what everybody likes to know. Is there a rule of thumb or a valuation multiple on how a dental practice is priced or worth? But I think if we take that one step further and we look at it from the private equity perspective, right? Because are there multiples? And I'll caveat it, be an evaluation professional, by saying that these multiples can change every day and they are averages and they're just like, nobody should really consider them, but everybody wants to know. Now, do private equity, do they have some current kind of ways that they're looking at practices and kind of pricing them? Maybe that's helpful insight to a dentist at this point.
Yeah. I mean, the way I think about it is sort of in groupings, and again, this is very, very broad brushed. As we touched on earlier, there's so many factors, and we didn't even go into all the factors. I just mentioned a few highlights of things that we look at when we're looking at what is the real value of this business. But in a broad brush, I would say, your typical solo practitioner, probably 3 to 5 times EBITDA. If you're a single location with multiple doctors, or maybe you're 1 to 3 offices, 4.5 to 6 times. If you're, anywhere from 3 to 10 locations, you're probably 6 to 8 times. If you've got a robust or a strong historical growth trend with a robust pipeline for growth, whether that's through acquisition or opening new offices, then you're probably getting to the 8 to 10. And then, to really get over a 10 times, you've got to have the growth, you've got to have the doctor retention, and you've got to have a team in place that can help the business continue to grow even further. And again, that's also just very broad brush. And, we certainly see, I just heard, I guess, right before Thanksgiving, of a large group that offered 8.5 times on a solo practitioner, in Western Massachusetts, which is seems like a very crazy multiple to pay on that type of office. But, I think that group is probably about to have their own liquidity event. And so they're probably just trying to get some more revenue,
right,
under them as they think about their next process.
Well, and I think that piggybacking on that kind of concept, are there things, because I think we've clearly identified the things that you need to focus on to make your practice worth more, right? Are there just a handful of things that could actually decrease the value and that people should start working on in their practice?
So not so much decrease, but certainly one thing that definitely is generally overlooked is accounts receivable balances, and especially credit balances. So really making sure that you're collecting money due to you on a timely basis. And also these credit balances, especially when you're dealing with today's sophisticated buyers, can really become a bit of an issue, and it usually ends up coming due, or coming up close to closing. And so then people are scrambling to figure out what to do about them. So really paying attention to that, I think, is important and critical if you're anywhere close to thinking about a transition. In terms of bringing a valuation down, again, I think the physical plant and the technology side of it are big, because, those can be some pretty big dollars if a new owner has to come out of pocket early to make those upgrades.
And when we're talking big dollar, we're talking pieces of equipment that are like 50 grand, 100 grand, 150 grand.
Yeah.
This isn't just like, oh, a couple grand. It's, if you're going to buy a practice and then you're going to have to put another 150 to 300,000 in to just get it up to speed, a buyer is going to want to not pay as much for the practice, right?
Yeah.
Yeah.
Yeah. Yeah. And then, I guess I would say, if there's a lot of turnover, especially if it's a multi-location. So if there's a lot of turnover in your doctor ranks, but if you're a single office, if there's a lot of turnover in your staff, that would suggest, there's probably some issues there. Obviously, any sort of malpractice claims or reputational, negative reviews can certainly impact. And then any sort of personnel type issues between doctors and staff is never good.
Yeah. Yeah. I think I deal with those a lot in divorces.
Yeah.
So probably steer clear from there. So let's say we have a dentist and maybe a solo practice or a few dentists, a few hygienists and things like that. And they get approached by a DSO or a group practice. What are some of the terms and conditions that they could expect that maybe they wouldn't think of? Because a lot of people think, I'm going to sell my practice, you give me some money, and then I just leave. Like, I don't need to stay here, right? So what are some of the things that they should be mindful of?
Well, so first I would say it's not if they get contacted, because they're getting contacted today. I mean, the amount of outreach, whether it's directly from a private equity firm or a strategic partner, or even, brokers are really trying to go directly to doctors to try to convince them to sell their businesses. And, as the consolidation continues, that's probably only going to get worse, because we're going to see more and more groups, and we're going to see bigger groups. And the best way for them to grow is through acquiring practices. Just as a point of reference, and I don't know that anyone has any super accurate count on this, but, what I've heard is we're probably about 35% consolidated at this point. So still, quite a ways to go. But I think that
like a lot of times I think I'm seeing dentists, they're still needing to stay on for, it could be a while. And these are, dentists and doctors and a lot of entrepreneurs don't always want to take direction from somebody else. So I think in some cases, it's not just, hey, I sold you my book of business and I'm out of here. They usually want 1, 2, 3, 5, years of somebody to work there, or indefinitely.
Yeah, I mean, it depends. I would say, in most cases, the longest term that they're going to require is probably 5 years. Certainly 1 year would be the least, and pretty unlikely depending on the circumstances of the business so, as a solo practitioner, it's probably going to be more critical that doctors stay longer, say 2 years, as opposed to if you're selling, a multi-office, multi-doctor practice, maybe there's some shifting around. So that maybe, say, a senior doctor could, in essence, retire as part of the transaction. But, by and large, typically, there is some requirement to stay on, whether it's in a clinical or, more managerial role. Some of the other things that you might come across would be a requirement to switch supply companies, a requirement to switch lab companies. Most of the larger groups have what they call a formulary, which is specific, inventory items that are approved. So you'd have to switch to their formulary typically. Some of the other things that could come into play would be restrictive covenants, and depending on, who you're transitioning the practice to, there can be two levels of that covenant. One can be sort of clinically focused, and then the other can be managerial. And so the managerial restrictive covenant typically has a wider geography that it covers, because the buyer is saying, once you become part of our organization, you're going to learn our secret sauce, and we want to protect ourselves against competing against ourselves for some period of time. So that's usually something that most people aren't accustomed to seeing.
Yeah, the non-compete, I think, might survive beyond. You might have to work for a year or two or three, and then there could be still a non-compete that could be pretty significant,
Right.
Going beyond that,
Yeah.
right?
Yeah. Another big one is compensation. So, most groups have compensation formulas. I've heard anywhere from 25 to 40% of collections. Specialty has its own sort of way of looking at that. But, that's a big one that, again, when, I'm working with clients, there is a little bit of leeway there. And what I hope to convey to my clients is that obviously the more that you get paid, the less EBITDA you're going to show. And so there's an inverse relationship there. And, oftentimes for many of the clients that we work with who don't want to work another 5-10 years, they're really better off getting more purchase price than they are getting annual compensation. And a lot of that comes down to the differential in the tax rate, which we currently enjoy, which, who knows what'll happen going forward. But, that oftentimes I get into these conversations and, most doctors will just do a simple calculation of like, well, this is what I make today, and this is what I'm going to make going forward. And it's like, well, but today you're paying probably 40% or more in taxes. And, if you do this transaction, you're going to get most of that money. It's really, prepaid cash flow is what you're getting. You're going to get most of that money at,
probably
at least 20% or low, 20% less than what you're paying or more. Right. That's definitely something to think about and consider.
And there's a fine line with compensation about, what is reasonable and what you just want, right? We all want to get paid more, but what's reasonable for the industry. And I do tell people like $1 of W-2 wages or compensation equals $1 of compensation, less taxes,
Right.
and $1 of cash flow in the business could equate to $3 to $5 of value in the business. And so it is better dollars at the value level or the business value level than necessarily at the income capacity level. But you also, if you sell and you are making 125 or 150 or 175 and you preferred 250, I totally understand that. But that's usually where they may continue your salary if they don't have a metric to recalculate it, right? So you're not going to be earning what you did in the past. You're going to be being paid for that.
Right.
And then you're going to have a reduced salary going forward.
Yeah. I think another this is more of a technical point, but it's very interesting, in the couple of divorce cases that I've been asked to be sort of a second set of eyes on or a second opinion on. Oftentimes, the salary calculation is the biggest area of dispute because especially when you're dealing with a solo practitioner. So many solo practitioners may not take salary.
Right.
Okay, so you have those that don't take salary, and then you have those that take salary for basically retirement purposes, right? And when you think about evaluator trying to get publicly available data, if they're getting data that's based on tax returns of a dentist, NASIX code or whatever, those salaries are kind of arbitrary, really.
Mhm.
And, I've seen this a couple times where, that's what the valuator used, and it's really created, a very inappropriate valuation because it's so below market.
Yeah, no, I think it is a complexity, even with most businesses, including dental practices and everything, even the salary differs by area. It differs by, I mean, you could both be in the same area, but one is urban and one is suburban and one is rural, and you're going to have different metrics and all of that. So I agree. That's a lot. Now, if we look at, are there any different terms that private equity will kind of apply, or are they dealing with more earnouts, or is this even a concept kind of in the dental practice transactions?
Well, I mean, when you're dealing directly with private equity, it's just a totally different transaction style or structure. And so, private equity typically is not going to partner with a single location. So they're going to want to have some amount of footprint.
Diversity.
Yeah, in terms of locations. And generally, those that are looking to partner with private equity are typically doing so because in their current conditions, they can't grow at the pace that they want to grow.
Mhm.
And that can come from several different areas. It can come from time, lack of time. It can come from lack of people. So access to quality people that can help you scale your business. And then probably most importantly is money. So most traditional banking relationships today that are working with dentists across the country, they have sort of a governor on how much growth they're willing to allow a group to have in a given period of time, typically a year. And so, generally we see that as being, allowing a group to do 1 to 2 either acquisitions or new offices every year. And so, many of these groups have ambitions far beyond that. And so, entering into a relationship with a private equity firm certainly gets them better access to capital, hopefully gets them some guidance and maybe access to talent, especially at the, more executive levels of an organization. But what comes with that is generally, they're going to want a longer commitment from you because, you're the founder and or operator and driver of the business. And in many cases, some of these private equity firms have never invested in healthcare. Maybe they've never invested in dentistry. And so, they need you to continue to make sure that their investment not only holds, but really grows, which is why, they're interested in partnering.
Well, and are private equity then looking more for like younger, more technologically advanced, or certain, I mean, are they even looking at certain areas like braces or orthodontry, or what else, oral surgery or cosmetic surgery? I mean, are there certain areas that because in my mind, that would be younger doctor that's really trying to kill it in social media, that's trying to like grow the practice crazy, that but wouldn't have the money to kind of do it. They would be interested in that. But are they looking for a certain profile?
So that's a really interesting question because there's been a huge shift. So, back when I started in this space, most investors wanted control. And so the typical relationship was there was like a friendly doctor that held the license, to abide by state regulations. And then, most of the decision-making authority was with, that management entity. And, I think that worked fine, for many organizations. But, what I think people finally woke up to, and especially investors, is, if we really want these businesses to grow and succeed, if we really want to have retention of our doctors, and as we have to go lower into the age bracket, to find partners or even just acquisition candidates, we have to become a more attractive option. And so we've seen this tremendous shift where most DSOs today have some sort of equity role component, for certainly the doctors. Most of them have paths to partnership for associates that either are there as part of the transaction or come on later. And so there's really this, focus on making the doctors have a position in the company that allows them to also benefit from the growth that largely is probably going to be driven by what they do on a day-to-day basis, not only as themselves, but overseeing their teams of hygienists and assistants. So that's been a big shift, and I think a really great opportunity for all parties, because while there are a number of very entrepreneurial dentists that certainly are talented both clinically and business, have business savvy, the vast majority get into dentistry because they love dentistry. Right. They love the clinical aspect. They love working with patients and helping patients. And, this model, I think, really helps marry those two, provided you find the right partner. As a dentist, if you can focus on your clinical work and you've got somebody, a partner that really understands how to run a business, that really understands how to manage people, that really understands how to negotiate a bank line, how to negotiate a contract with an insurance company for better reimbursement, how to negotiate a supply contract. I mean, all of these things that now are making it much harder to be a business owner in dentistry. It's a really a win-win situation. And so, we are seeing even joint venture relationships. I mean, there's probably any way that you could think about partnering with somebody, it's probably exists in dentistry somewhere.
Well, and to that extent, I think that, in some cases, how are the dentists attracting these younger dentists to transition into the retirement? And, or like what you've just said makes me think that, there is a difference. Before, if you were a dentist, right, when 20 years ago, whenever we started kind of doing what we were doing, you either went to work for somebody, like another single person, right? Or you just did it yourself and you bootstrapped it and you figured it out. And those were the two methods. Now that we have kind of younger, the world is different, just period. Mm-hmm. And now that we have that happening, do you think that it's the younger dentists that are kind of creating this opportunity for private equity, in the fact that they're not maybe made for entrepreneurship? They are not built for that. They don't want the risk. They already have the debt that they have to pay off. They want a job. They want a paycheck. They want a constant flow of clients. But they don't necessarily want to go get them, right? They just want them to show up. They want to show up every day. Do you see that as part of what's changing the landscape a little bit?
Yeah, I don't know if there's like, the whole bunch of things just popped in my head, because there's so many interesting sort of macroeconomic things happening that I think are impacting, what's going on in dentistry, especially with group practice. So, we talked earlier about the debt loads that students face. What we didn't talk about was the cost of owning a practice. So whether you buy a practice or you build one from scratch, that's anywhere from, $500,000 to $1 million+ dollars. And not only that, that's much costlier today than it was years ago because we have so much technology today that, again, is becoming standard of care. So we've got those pressures there. Now, what you also have to think about is the pressures on your revenue. So today, there is more insurance involvement in dental practice than there was 25, 30 years ago. And not only is there more insurance involvement, but there's downward pressure on reimbursement rates. And so when you think about that, you've got your revenue, you've got downward pressure on your revenue, you've got upward pressure on expenses. Then it becomes really tough to be successful if you're not business savvy, if you're not willing to kind of put 7 days a week in, for some period of time, not forever. But, it's always interesting to me, working with clients that are, say, 60, 65 plus, they always talk about how when they first started, they were open 7 days a week. They did whatever it took to, make sure they could support themselves and their families. They would work late into the night, early in the morning. You talk to most, new graduates today, they want to work 4 days a week. Mm-hmm. And these, some of these conversations I've had are graduates that have $500,000 in debt and they want a BMW and, so it's an interesting dynamic there. And then the last thing I think too is, we're now over 50% of dental graduates are female. And we know that while there's, some amazing female doctors and amazing entrepreneurial female doctors, most female dentists at some point in their career are not going to be, in the practice because they're going to be focused on family. But, I think when you think of all of that coming together, and also maybe sort of an answer to what we talked about earlier with senior doctors slowing down, rather than slow down, there's so many options today to sell your practice to a group, still be able to work, and then gradually reduce your schedule. Right. But you've already gotten, the equity of your business. And now as part of a group, group practices have a bit more flexibility with being able to have, maybe there's one doctor who works 2 days in this office and 2 days in that office and, whatever it is, or maybe there's, split schedules because they do a 7 to 2 shift and a, 1 to 8 or whatever it is. But, I certainly think that there is a lot more flexibility for doctors of all ages working in a group model. And, not so much that this relates to the owner of the business, but the group model also affords every person on your team a greater opportunity than they would ever have if it was just a single location. Mm-hmm. And I talk about this a lot with clients because, most sellers have very strong relationships with their teams and they really want to make sure that there's a place for them post-transaction. And in many cases, not only do those teams retain their positions, but again, you might have an assistant who just really has a knack for, managing inventory. And now that assistant maybe she becomes the inventory manager for 4 offices.
Right.
Or an office manager. Maybe that person can become a regional manager and they can now oversee 6 locations. So, there's a lot of opportunity, I think, for all people in the group setting. And I think for a lot of the macroeconomic things that we've talked about, it makes sense for a lot of people.
Yeah, no, I think that this has been really helpful. I think my last question, in case we, want to go further, but so I'm a dentist, right? And I've been doing this for a long time. And I'm just sort of moderately getting tired, right? Because like I know right now our dentist from the pandemic, because of the pandemic, they were like, "Hey guys, you guys are late for your 6 month. Come on in for your 6 month." And we called, and my husband called, and they're like, "So we can see you in 4 months." I was like, what? So, I mean, there's a lot going on right now. There's a ton of patients, a ton of business. But I think also people may be like, I'm tired. I want to take a break. So if I'm a dentist and I'm somewhere in this phase, right? How do I determine what path is right and how should I transition my practice? Because in mergers and acquisitions, we tell people to think 3 to 5 years
Yeah.
years
Yeah.
before you're actually ready to step out the door. So like, how do I figure this out then?
Yeah, I mean, certainly having the conversation sooner rather than later is critical. I mean, I think for again, think back to the conversation we talked about earlier, where we've got the doctor whose practice has declined. He or she has a certain understanding of what they think the value is or the value that they need, which may or may not reflect conversations they have or have not had with their wealth managers or their financial advisors. And, if you come to me and say, I need to sell in 4 months, that makes it very hard for everybody to really help you make sure that you get the transition that you deserve, and that will, ideally set you up in the best way. So I think having those conversations 3 to 5 years out with, whoever's on your team, CPAs, other advisors, financial planners or wealth managers, is really critical. One, to make sure that you're positioning the practice so that it will receive its highest and best value, but also to ensure that you're selling it with your retirement in mind and your needs for your retirement in mind.
Yeah. I mean, I think I've seen some practices where, we'll use easy numbers. Let's say they have 250 to the bottom line or EBITDA, right? And I say, okay, you can probably get 750,000 3 times. Okay. Let's just make up numbers right now. And they'll be like, what? I need $3 million to retire. And I'm
Right.
like, okay, well then you have 250,000 that you can earn every year. And then you're going to be able to sell it at some point. So, part of it is how much further do I need to work?
Right.
When do I need to sell it? But I think that a lot of times they're like, well, I need it to be worth this because that's how much I need to live. And
Right.
that's usually way more than the practice could be worth. And then we have, well, then you should go get a valuation. Like you should see what the value is. And I think that that's a good step. I also think it's a really good step to reach out to people like you who are actually sell, like I'm valuing them.
Right.
I'm not selling them.
Right.
Right. So I can do the hypothetical and I can look at all the numbers and I can look at all the metrics. But when it comes down to it, you're going to also need to partner with somebody who can tell you what is actually going on, because how deals were getting done, I don't care what industry you are in, pre-pandemic is not how deals are getting done post-pandemic.
Yeah.
And that's just one example.
Right.
But I
Yeah,
think
we're always more than happy to have a call with somebody. Obviously, it's always better for us to have more time to develop a relationship with a client, but I'm always happy to have a call with someone to give them just a quick test on where the market is and how their practice fits into that. I think the other thing I would also say is, which I always hesitate bringing up, but because it's the Debbie Downer side of it, in that you never know what's going to happen. I mean, I can't tell you how many clients I've worked with, 70 plus, that say, well, I don't need to sell because, I'm healthy and I feel good and I'm still, can treat my patients at the level that I want to. And, I've heard too many other stories where something happens and, the minute something happens, the value of that practice becomes, very questionable.
Mm-hmm.
Um,
Well,
it
and
puts a lot
even,
of pressure on the family, potentially.
yeah, I mean, I think
Looking at
it's,
that.
and it's not just death, right? Like, we're
No,
not
yeah,
saying something bad. We're saying like dental practice and doctors, it is a physical job,
yeah,
and so there are, I've known a lot of dentists that have had some physical ailments from even doing the work,
yeah.
so I think that you have to keep everything in mind. But tell us more about you, your firm, how people can contact. We're going to show kind of some ways that people can contact you, because I think, you have given even more information that I thought. I had a few epiphanies and I'm like, oh yeah, that's good. I like that. So, how can people kind of get a hold of you? You said you offer to talk to people. I think that's amazing.
Yeah.
Um, you're one of the managing directors at Caber Hill,
Yep.
correct?
Yep. We have a new website, so we're really thrilled about. So please come visit
Check
us
it out.
and check us out. And I think you'll get a real good sense of who we are and how we can help. I would say, are really focused on, especially myself. I mean, we have, a number of people on our team, but given my background in history and, whether it's a blessing or a curse being a CPA and detail oriented, I tend to really dig into understanding, what's going on in the practice or practices. And really what that does is help me make sure that I can convey to you what the real value of what you're going to take to market is. I spend probably almost exclusively my time representing sellers. And there are times when the firm will take on doing buy side advisory, but primarily we work on sell side advisory. And again, I think we enjoy having a bit more time, not only to get to know our clients and their businesses, but to then also make sure that we can make sure that they get the maximum value. And running a process or thinking about a transaction is definitely can be time consuming. It definitely can be distracting. And so again, the more time that we have to plan for it, and to also then make sure that we understand exactly what you're looking for and what you want to achieve through a transaction, just helps set us up better to help you and advise you.
Yeah, and it really is. I appreciate all the information that you've provided. It really is a relationship. I mean, it's not like you're going to sell your house and you just need to pretty it up and get a real estate agent and sell it. Like, this is a livelihood, it's a process, it's a transition. And it's also thinking about what you're going to do next. So I think that reaching out, I think there's also a benefit in working with somebody who is exclusively in this space, because your connections to the private equity, your connections to other DSOs or group practices or transactions that you've done do help position that person or that doctor in a different light and different options. So I think that it is good to at least start the conversation. And if you find people, yes, some of the people are like, oh, come on, I'll sell your business. But that's not, for the most part, it's really people understanding the industry, looking at what positive things you have in your practice and what somebody is looking for in a practice and connecting them. And sometimes that takes time. And it also takes time for you to get out of the mindset of doing this work every single day, So both of those kind of happen over time. But I think building that relationship and being ready, even cleaning up your books and doing different things will get you in a better position when you are ready,
Right.
like, because we're sort of ready, like we want to know more, and then we're ready to take the leap. So, but reaching out to you, they can at least get started in that process. You do understand business valuations.
Right.
You do have a financial background, so
Right.
so you get all of that, but it would be specific to how you price a dental practice. So I think that's really unique experience. So
Yeah, and I think too, it's also, this is one of the biggest decisions most people in this situation are going to make, and there's always a lot of emotion with that. I constantly say I wish I had a degree in psychology, and maybe I have one just through experience. But so again, getting back to that relationship and having that time, and also I think what is really great about being part of Caber Hill is, while I specialize in focusing on the dental industry, others in our firm do not. We generally, we are heavily healthcare focused, but the benefit of that is that not only do you get the dental expertise, but we also see deals across all different sizes, other industries. We interact with a lot of private equity firms, those that are focused on healthcare and not. But we're also seeing, terms and conditions and trends, not just based on dentistry. And I think that that's also pretty valuable.
yeah, no, that's awesome. Well, thank you so much for your time and all of your knowledge today. And I'm sure things change so quickly. Maybe we'll be on talking about more changes in the industry. So thank you, Maria, so much.
Oh, thank you. So this really was a lot of fun. And I hope we can do it again at some point.
Awesome. Thank you.
All right.